Good afternoon, everyone. My name is Brad DeYoung. I'm a partner and the director of our senior living services here at I. Bailey. With me today that'll be presenting is Sean Delury. Sean Delury is one of our senior managers and specializes in helping our clients navigate this wonderful employee retention credit tax option that we have out there. Sean, why don't you go ahead and advance it? Sean's out of our Minneapolis office. I'm based in the Fargo, North Dakota office. The two of us have been working with these tax credits with multiple clients now. As I said, Sean's really leading this. When you start, everybody's wondering employee retention credit. What is this? Okay. I'm going to start with the idea that right now, a lot of you are probably, if you're listening to radio, your favorite station, you hear these ads talking about this credit that's out there. We've had lots of clients that have been getting phone calls and saying, hey, I think you should be eligible for this. And, we've got a lot of questions. Everybody's just like, well, what does this mean? What's the options? So with that, that's really why Sean and I are coming to you today. We're going to go through what the legislation was here. We're going to talk about how we build the opportunity to come up and say, are you eligible for the employee retention credit? Qualification criteria. What are some of the specific things that healthcare organizations can look at? We'll take some questions here in the end and go from there. So with that, let's go back and look at this employee retention credit and recent legislation. Where did this all come from in the first place? So the employee retention credit, ERC from here on out, started with the CARES Act in 2020. It was extended and expanded in the CAA and the ARPA. So those were subsequent legislative actions that occurred in late 2020. The retention credit first started out in 2020 as being a $5,000 per credit per employee credit. Okay. In 2021, it was expanded to be $7,000 credit per employee per quarter, or in other words, $28,000 per employee for 2021. Subsequent to those bills, there was some recent legislation that repealed the impact of the ERC for quarter 4 of 2021. The question is will that come back? We don't know. There's always a chance that Congress could pass this, expand it back to quarter 4. There's always also the chance that they could pass new laws that would limit this further than the 2021 quarters 1 through 3. So there's always that chance out there for potential legislation to change this. But in the end, this really was initiated back in 2020, subsequently expanded in those 2 bills, and it does provide a very substantial credit for organizations. When you start thinking of $7,000 per employee per quarter, it's significant. Okay, so let's look at how do we build what are the basics of the employer retention credit? The first item here is you got to look at your time periods that we're going to be covering. The ERC is eligible for you from March of 2020 to December of 2020 under the initial that gives you that $5,000 annually. It's based on 50% of qualified wages. So you don't just get a $5,000 flat credit for an employee as an example. What you do get is you get 50% of their qualified wages. So if an employee makes $5,000, the credit's only $2,500. If they make $10,000 or more, you're going to get $5,000. In 2020, one of the other things, in order to be eligible for this, you had to be considered a small employer with less than 100 full-time employees. Now, what that relates to is that's 100 full-time employees. And a full-time employee is defined as an employee that works less than 130 hours on average for the entire calendar year. And we use 2019 as the base year to calculate that information. Okay. In 2021, we've got the credit for 3 quarters. And now the credit jumps from 50% of qualified wages for the annual compensation to 70% for each quarter. And it's 70% of the first $10,000 in wages. So again, you start talking 7,000 quarterly right now. If you qualified for all 3 quarters, it would be $21,000 per employee. The other thing that 2021 changes is it raises the bar as to what's considered a eligible small employer. Instead of going with 100 full-time employees, you've now moved over to 500 full-time employees. Now, when you start looking at this, the full-time employee, what we suggest you do is you really almost have to take month by month for 2019, list your employees down for the month, figure out which ones do and do not meet that 130-hour requirement. Okay, so if January comes out to be 498, February, you put the number down, it comes out to be 502. You average those every month. You got to total it up by month and then average it over the entire year. If in the end you're below 500, you're good. If you're at 501, unfortunately, that's not so good. There's always going to be a cutoff when it comes to rules and regulations, and unfortunately, that is a cutoff that you do have to make sure you're looking at. There's a little bit of nuances in how we calculate that, so make sure you're, if you are close, make sure you do visit with your financial advisor and come back to what you're really looking at. Okay, now let's look at how do we become eligible? First you have to show, in most part, a decline in gross receipts. So in 2020, if you had gross receipts that declined greater than 50% in any quarter of 2020 versus 2019, you would qualify. So again, I'm going to be a nursing home as an example. And if I was generating in 2019 on a quarterly basis, I was generating about $1 million in revenue. In 2020, I was down to 450. Really a good chance you're going to qualify in that situation. But that's just kind of what you have to look at. In 2021, that was changed where your gross receipts only needed to decline 20%. So when you look at those first 3 quarters of 2021 versus the first 3 quarters of 2019, if your revenues declined by 20%, you qualify. And that's all you had to do to qualify, is just show that number dropped. Now on the alternate quarter provision, okay, it's not applicable to 2020. So keep in mind, you kind of got to stay with that first thought on 2020 up above. In 2021, you could actually look back to the preceding quarter to qualify. So what we mean by that is, if in December or the 4th quarter of 2020, you actually had a 21% drop in revenues, even if the 1st quarter of 2021 only showed an 18% drop in revenue, you would still qualify for that 1st quarter of 2021 because of what happened in 2020. Okay. When we start talking about gross receipts definitions, really what they're going to follow here is IRS rules and regulations, but they do include all receipts. So we have to take into consideration provide relief funds, interest income, PPP loans. So we're finding in a lot of those situations, because of the significant receipts that were brought into organizations in 2020 and the PPP loans, it really does make it a little tougher to qualify at those time periods. But keep in mind, you do have to keep all revenues into consideration. There's really not a whole lot that's excluded here. So just when you start that conversation, start looking at it, understand and just say, we got to take all revenues into consideration to make sure that we're meeting that 20% drop in 21 or the 50% drop in 2020. Now, if you can't meet those drop in revenues, there's also an alternative way here to qualify. One is your operations were fully or partially suspended due to a government order, okay, that's in place during that period. So when you think of this, you would say, I'll go back to our nursing homes. Because of rules and regulations, there was isolation requirements for residents. And because of that, we had facilities that maybe had double rooms. Well, in order to make sure that they were protecting and honoring, making sure they didn't put into some residents into jeopardy by bringing a resident in from the outside, they had to go to full isolation, which required them to reduce their overall capacity in many locations. That government requirement that said that, you can't, if you cohabitate a room, those two must isolate together all the time. And if you take one out of there, you can't bring them back in. That in itself would say that that was a government requirement. So that's just one thing that you could look at and say, this government order had an impact on your ability to provide your operations as normal. Okay. So there was some level of operational suspension on a full or partial basis there related to a government order. Then the, government instrumentalities are also eligible in 2021. They were not eligible in 2020, and only certain ones are eligible. Again, that medical and hospital care, that was brought in, or they specifically noted that medical and hospital care providers that are governmentally owned. So we see a lot of healthcare entities that are county or city owned. They would be eligible to participate in the credit in 2021. They were not in 2020. Okay, next slide. And we get to polling question number 1. So an organization needs to have a decline in total or organization-wide total gross receipts in order to qualify for the employee retention credit. Is that true or false?
Okay, so we got this is Sean here. We got 46% said true, 54% said false. That's a good mix. The answer is false. Actually, it's worded kind of funny. Don't have to have a decline in total organization-wide gross receipts, just because, as Brad mentioned, we can qualify based on that suspension of operations, and then that would result in us not needing to have a decline in gross receipts on all of our gross receipts. So a helpful aid there. So I'm going to talk about next is about aggregation and control groups. We just wanted to mention a little bit about, and Brad did a great job going over those building blocks there. If you peel the onion a little bit around qualifying as a small employer, as a large employer, one of the things we need to look at, and we find with nursing facilities or other hospitals, is aggregation issues. So we might have a parent-sub relationship, or we might own some other business or entity with our whole campus or our whole organization. We'll have to look at aggregation and control groups. Well, the IRS relies on IRC section 414 for entities to be aggregated based on common ownership. And those include, like I mentioned, parent subs, brothers, sisters, where you might have a slew of entities, 5 or fewer, owned by a group of owners. That would be a brother, sister. Then we'd have to aggregate those for the ERC analysis or for ERC purposes. Look at management companies. Some of you might have a management company providing services for you. They might need to be aggregated with your facility. There's also some more nuanced things we've seen with affiliated service groups. I haven't seen these a lot in like senior living spaces, but around the clinical area, we've seen a lot where they might have a surgery center that they don't own, but they do a lot of work with. And because of that, they got to pool in the surgery center through an affiliated service group. So just be on the lookout for some things that you have relationships, entities you have relationships with that you might not structurally own like you do with a parent sub or brother sister. You might have an affiliated service group with them. I have a few clients that I'm still working through those issues with. And then there's owner attributions. If you have the parent, and literally their kids might have ownership, they would have their parents attributed to them in terms of their ownership percentage, which could change things through aggregation. A lot of facilities obviously don't have these, right? But there is some that do, and we just want to make sure that they're being looked at as well. Some of the impacts on that is that, again, like I mentioned at the open of the slide, it affects whether you're a small or a large employer. So do you have, as Brad described, that 100 or fewer full-time employees for 2020 or 500 or fewer full-time employees for 2021. This could trip you into being a large employer. And then it also deals with the qualification test for decline of gross receipts and the nominal impacts or suspension of operations. So take the decline of gross receipts, we'd have to include all the entities as an aggregate or a control group for those declines of gross receipts. That might change our answer compared to us as an individual facility. And then nominal impact as well, we'd have to look at the controlled entity, the total entity, to see if we have we were nominally impacted. So a note on aggregation. So we put this slide together to kind of look at the decision tree of looking at ERC. How do we look at this? There's a lot of things to unpack. As Brad described, there's a lot of rules. There's a lot of criteria to look at. So I guess the first thing when I look at a client or as an organization, I look at, well, what is your structure? Are you for profit? Are you a nonprofit or governmental? As Brad described earlier, governmentals can't qualify for ERC for 2020, but they can qualify for 2021. So some help there for governmentals, and then for a nonprofit, obviously we can qualify for both of those years. Employer size, are we a large or a small? I think as Brad mentioned, being classified as a small employer is beneficial to us from an ERC perspective because we can take the ERC on all our employees. If we're a large employer, then we can only take it on those employees that didn't work and were furloughed. So we paid them. I have a client right now I'm working with that paid a number of furloughs and they furloughed. So if they were a large employer, they could only take the ERC on those furloughed employees and not all employees like a small employer can. The other thing to look at is qualification criteria, like Brad talked about. We'll continue to go over decline of gross receipts, or the other avenue you can take is the suspension of operations due to a government order. So not just the decline, we can also qualify based on other criteria. And then that feeds into the calculation, right? Do we qualify for 2020 and or 2021? Look at qualified wages, see how much we have. There's a lot of providers, or you can do your calculations yourself, or come to, there's a lot of companies that do ERC. Obviously we do as well. Looking at qualified wages, see if you reach that 10,000 per employee to get to that maximum ERC amount. The covered period differs depending on whether you do the decline of gross receipts, right? Because if you do that, your covered period would be that quarter that you are looking at. If it is a suspension of government order, then as Brad said, you're tied to the length of that government order. And then we also want to look at the accounting for the other incentives. We want to look at the provider relief funds. We also want to look at PPP. One thing Brad talked about, which we'll talk about later, is how do we interplay PPP with ERC. One thing to know on the revenue or the gross receipts is the PPP loan is not included in the definition of gross receipts. So if we have PPP forgiveness, we do not have to include that PPP loan forgiveness in gross receipts. So that's one nice benefit that we got there. So let's go through an eligible employer test, right? Let's look at 2020. We have a significant decline of gross receipts here potentially. We are going to look at calendar year 2019 and calendar year 2020 and see if we have a quarter that has a greater than 50% decline compared to 2019. So I'll look at Q1, Q2, Q3, Q4 in that table. 2019 gross receipts. Brad kind of mocked up this earlier saying $10 million entity. So here we have 10 million gross receipts for Q1. 2020, we were not, maybe this entity was not affected by COVID very much. So then they're at 9 million, right? We have a 2020 is 90% of 2019. So they're not eligible for Q1. Let's take a look at Q2. COVID hit in this example. We have 12 million in 2019. Look at 2020, we have 5 million. So the 5 divided by the 12 is 42%. We are eligible because we're under that 50% for Q2. We look at Q3, we bounce back up. We're at 9 million compared to 11. A lot of people would look at that 82% and say, oh, we're probably not eligible, but ERC contains a rule. I mean, there's stacks of IRS notices that we need to read through for ERC. So we actually get to include Q3 because it was the first quarter that we passed that 80% threshold. So we get to keep qualifying if we're under 50% until we surpass 80% in another quarter. And that's what we do in Q3. Q4 doesn't qualify because again, we have to go under that 50% again, since we passed that 80% in Q3. So Q4, we would not qualify as a result. Another thing to mention is gross receipts it's a very inclusive definition, as Brad mentioned. I mean, it's basically all your gross receipts, right? I mean, net patient service revenue, your other operating revenue, your other income. The only caveat I'd say we exclude, which is nice, is the PPP loan forgiveness. So we do not need to include that in gross receipts, but everything else, like Brad mentioned, provider relief funds, we include those in gross receipts. And then again, like I mentioned, aggregation rules apply. So if we have other entities we need to include them in gross receipts as well. So there was a question here. I'm just going to read it now and see if I can answer it, since we just have one here, and it's probably relatable to this slide. So if a large majority of your services are being provided by temp labor, for example, and you are paying the temp staff agency issuing a 1099 at your end, do they count for the 500 employee figure? That's a good question. So for temp employees are not included for ERC, so they would fall back to the staffing agency for that. Now we've seen some cases where the staff agency may share in that with you. You might come to some sort of arrangement on that, but generally speaking, it's the ERC is just on those employees that you have and employ. To the next slide for 2021 gross receipts test. So again, like Brad mentioned, that this is a great opportunity as the gross receipts decline from a greater than 50% decline to a greater than 20% reduction compared to that same calendar quarter in 2019. So very helpful. And as Brad mentioned, you get to use the elective alternative quarter. So as he laid out, like even in 2020 Q4, if you had a greater than 20% decline in Q4 of 2020, you could use that to qualify in Q1 of 2021. So a nice thing there. And I like to say too, is you can mix and match. So I mean, if in Q2 you didn't qualify, you can use Q1 if it was greater than a 20% decline. And then in Q3, let's say at a greater than 20% decline in Q3, then you could also qualify there as well for that. So there's some nice things there. For employers that are not in existence in the same quarter in 2019, you can use 2020. So you can compare 2021 calendar year quarters to those quarters in 2020. So you're not out of the woods or anything like that. You get to compare 2021 to 2020. So that's some helpful things there. And with that, I believe, Brad, I'm going to pass it back to you.
Okay, well, we're going to kind of continue on here and talk a little bit more about what the suspension of operations means. In 2020 and 2021, you can only claim the credit during the suspension period. Okay, so what they're talking about here is if there was a regulation or a rule that was put in place and it was lifted. So let's just say, I'll just go back to the restaurant industry, and let's just say the rule was that they could only have 50% capacity in their business. And that was only through 2020, and it was lifted at the end of 2020. They would not be able to use that rule in any of their 2021 quarters. Okay. So IRS notice, a government order, essential business classification does not automatically disqualify an employer from being partially or fully suspended. So even though, we found our healthcare entities were considered an essential business, and then that kind of would say, well, then you shouldn't have had anything that impacted you, right? Because they were allowed to stay open and kind of run, but that is not the case, and does not automatically disqualify you. A couple of the other things in the suspension of operations. If you did have a suspension of operations or an impact because of a government order, you have to have more than a nominal impact. And really what the IRS is saying here is, if the order went into place, you still have to show somehow that order had some level of impact on your organization. What we're looking at there would be, let's go back to that order that said, where I talked about earlier, that said, hey, you're putting residents at risk if you cohabitate them in a more than single occupancy room. So really, because of the isolation rules and everything, we just felt you were required to go to a single room for everybody. But if you're already single rooms, how is that going to impact you? You know, there's really going to be no impact. So the nominal test really comes back to here is that you have to show a greater than 10% impact to that segment of your business. Okay. So when when I look at that segment of your business, you can break down your operations by various segments. It's not unusual to have, a hospital, clinic, nursing home. All three of those are segments. You could have one of those three segments be impacted by a government mandate. That segment could be the one that's impacted more than nominally, and how that the entire organization would be eligible for the credit. So that you don't have to just look at this as organization wide. That's why that was kind of that question we asked earlier too. And just to kind of reiterate there, it does not mean you don't have to look at the entire organization's impact for some of these pieces to be in play for you as an organization to participate in the ERC. Okay, so things where we say you weren't partially suspended. If public accountants, we basically everybody went remote. They couldn't have us all in the office, but we felt we had to go to remote and keep people away and isolate. We still were able to do all of our work. May not have been as effective, but we still had to do all of our work. That is not going to be a suspension of business. And if the customers are required to stay home, doesn't necessarily mean that you were suspended, but you got to take all those into consideration. And again, supply chain. We all have impacted supply chain issues, and that would, because the supply chains maybe weren't getting there, it's not going to necessarily see that you were partially suspended because of that government order that your supply chain didn't show up. Okay, polling question number 2. Okay, we did cover this one earlier. Governmental organizations qualify for the employee retention credit for years 2020 and for 2021.
There you go. All right. Looks like 60 true. That's good. It's a good turnout. The answer is false. So we can qualify for 2021, but we would not qualify for 2020. Qualified wages. So when we're looking at defining that a little bit further, qualified wages for ERC is actually based on Social Security wages or box 3 of your W-2. So it's not the gross wages, it's actually your Social Security wages, or as we like to get for the calculation, your wages subject to Medicare tax. You also get to include an allocated share of your employer's healthcare expenses. So that's a nice boost. We get to include healthcare premiums, dental premiums, vision premiums, and healthcare FSA contributions, flexible spending accounts. For health, we can include that all in qualified wages. So that's nice. Another point though is that, again, the large employers defined as more than 100 full-time employees in 2020 or 500 full-time employees in 2021, they can only claim the credit again on those employees that are being paid but not provide any service. So that's something to keep in mind. Those furloughed employees, if you're a large employer, that's what we can take for ERC. Small employers can take it on everybody. So that's why one of the big things we look at is like Brad said, what is your 2019 average full-time employee count? So something to consider. Again, consider aggregation rules when looking at those counts. So health plan expenses, like I said, they are eligible for ERC. That includes the cost paid by the employer, so the employer premiums, and then also the portions paid by the employee if you have a pre-tax plan or a part of a cafeteria plan. We can include those employee contributions for health, dental, and vision for pre-tax. If we're not sure what the employer premiums are, like it's a monthly amount and we can't break it down by employee or have premiums, sometimes we run into that with self-funded health insurance plans. The IRS does allow you to allocate those amounts to employees just based on a pro rata allocation, based on your covered employees and your periods of coverage. You just need to make sure it's somewhat reasonable and supportable if the IRS was ever to look at your allocation. But yeah, you can do it based on covered employees, what plans are they in, and then the periods that they're obviously enrolled in. And also health plan costs by furloughed employees are includable in the ERC. So another good thing there. So how do you ultimately claim the credit? Well, it's reported based on qualified wages and health insurance costs on your quarterly employment tax returns. So it's on your 941s. Obviously, we're past that point for 2020 and 2021, so we are amending 941s. We are amending those for the quarters that you qualify. There's a 3-year statute of limitations on those 941s. So, we get questioned a lot of times, how long do we have to file ERC? We have 3 years from when you filed. So we have a good amount of time here to get those in. So, I mean, if you're 2021, you have, I believe, up until 2024 and 2024 to file those ERCs. So plenty of time. Let's see. And then some other things to think about is, the ERC is different than other COVID relief programs. So there's no requirement to maintain a certain level of employment or payroll levels like there was for PPP. There's none of that. You just do the calculation based on number of employees you have and how much qualified wages you have. There's no overall dollar limit on the amount of credit you can claim. Large employers can get up to 10,000 of qualified wages or 7,000 per quarter for 2021 on their employees. You just need to have that amount of qualified wages. So there's no overall dollar limit there. Limit on claiming the ERC for an individual employer or owner hiring his or her family members. There is a limit on that. We run into this a lot on small employers or for-profit entities. I haven't run it as much in the healthcare organizations or space, but certainly if you have owners that have family members, they cannot, and you're structured as a C Corp or something other than a not-for-profit, you would be limited on those individuals. So let's talk about, if you're doing the ERC calc, we do want to make sure that we understand the documentation or substantiation requirements for ERC. So what sort of record should we keep? Obviously, you'll want to document and keep how you were eligible for ERC. And that includes your gross receipts analysis. What was your decline of gross receipts? Any government orders that you relied upon, we would want to document that. How was your more than a nominal effect on operations determined? Was it based on your gross receipts, or you can look at total hours of service as an example? How did you look at that to make sure that you met that? We do for our clients, we send them a calculations report that outlines the results of the gross receipts analysis, as well as the government orders, the exact government orders we relied upon, and then how we did the nominal effect calculations. So, we get that as a pretty clean, easy package PDF report to our clients that we work with. So if you're documenting that, you make sure you get those. Also the calculations for qualified wages. For large employers, you'll want to have records showing that these people that you're claiming didn't work, but you paid them and they did not provide any services. Any health plan expense computations, that allocation method, you'll want to have a documentation of that. Any aggregation, document that. And obviously your tax returns, you want to have your 941 and then your amended 941s if you're amending those, and have those available if you get asked for those from the IRS. And it's said to maintain your records for at least 5 years. That's what the regulations say there. And that gets us to another polling question. Polling question number 3. Let's see what we got here. Oh, wow. Okay. Include gross wages was 29%. Always include employee health insurance premiums 11. W2 box 3 wages, 53, and none of the above, and the tricky one, 7%. So the answer is C. We want to include, which is true about box or qualified wages, we always include W2 box 3 wages. That's always the case. So gross wages, we kind of want to shy away from because that can include some things in wages that wouldn't be eligible for ERC. So we want to make sure we're using the Medicare eligible ones. That's the box 3. We can't always include employee premiums. If we, for example, we don't pre-tax the premiums, then essentially that amount is in the employee's wages. And so we don't include the employee share if we don't pre-tax. So answer is C. There we go. Okay, PPP. Let's talk about the PPP program. So at the start of the ERC regulations, it said that, PPP, we couldn't take PPP and ERC, but we received some notices later that suggested that we can. So the PPP and ERC are not exclusive, but wages giving rise to PPP loan forgiveness cannot also be used for ERC. So when if we're doing this for clients, what we try to do is we try to maximize ERC by looking at your PPP loan forgiveness, looking at your covered period, seeing what expenses you took for PPP. Did you take utilities and interest, and did you use it all for wages? What was your covered period for PPP? And we'll look at that, and we'll try to maximize both programs. So we'll look at your wages by pay period and go, okay, can we take this amount for ERC, or should we take this quarter for PPP? And at the end of the day, we really look at it to try to maximize ERC while ensuring that you have enough wages to have forgiveness for PPP. Another factor there is that the last bullet point, I guess, to draw out is part of our analysis too, is looking at wage amounts that might not count for PPP expenditures. So those amounts in excess of 100,000, those can still count for ERC. So we'll definitely use those for ERC since we can't take them for PPP. So qualifications for healthcare organizations. Let's take a look at some specifics there. I think Brad dove into this nicely, but there's just a couple of things here. Just to broaden it out, for 2020, there was that elective procedures that brought into the game a lot of hospitals and clinics, possibly. Maybe some nursing homes were attached to those. The issue there, though, is that, for 2020, to qualify, we had to have less than 100 full-time employees. So that kicked a lot of us out of that qualification. So for 2020 and for 2021, though, there is, as Brad mentioned, some nursing home government orders that are very beneficial for nursing homes and assisted living and some other post-acute providers that we're looking at. So there are some great opportunities there that we're exploring with nursing homes. So there are government orders. You did have those. You probably saw a decline in your revenues, and if not, you certainly saw some in your resident days. So as part of our assessment process, we take a look at that and see where and if we can qualify for ERC. Also, if you're attached to a hospital, you're not excluded because of what Brad was talking about with the suspension of operations. A lot of times the nursing home will be enough of a nominal portion to qualify the entire organization. So we can look at, did the nursing home have impact due to a government order? Did it have a decline due to that in the revenues or the days? We can look at that and see if you did. If you did, that could qualify not only the attached nursing home, but also the hospital. So a lot of opportunities there with hospitals with attached nursing homes as well. Social distancing, I mean, there's a lot of talk around social distancing, right? Because we all had to do it. But the issue we find with distancing is it's a very gray and nuanced area if it had that 10% impact. So we may partner it with other government orders, but we don't typically use social distancing on its own, even though you had to face it. And, that's just something that we're not necessarily doing. You might, try to do it in your application, or we've seen other organizations that do ERC, maybe they would feel more comfortable doing it or would do it to use the distancing. It's just a gray area for us at this point, but we entertain talking to providers about it continuously. And again, just the point on the nominal, it needs to be, again, one, tied to a government order that reduced your organization's operational capacity by at least 10%. That nominal portion of your business needs to be at least 10% of your total gross receipts. And how you look at that is you look at each calendar year quarter of 2019 and see if you had that, see if that portion of your business was at least 10% of the total. And then it had to have, and again, it had to reduce your operational capacity by at least that 10%, comparing, those quarters in 2021 to those quarters in 2019. One thing to think about is maybe when you look at that, think about a different industry just to think about a little bit differently. I think Brad maybe mentioned the restaurants. We had a lot of restaurants qualify for this. Some of them due to a decline of gross receipts, but many of them had a decline of a nominal portion of their business. You think about like dining in versus takeout, and the dining in was closed. So then they had a government order there, and it was at least 10% of their business based on 2019 business. So then they would qualify for the ERC based on that in dining being done, even though a lot of these restaurants had takeout that had more revenue in the takeout than the in dining. So the revenue in total maybe didn't even drop. Back to that first multiple choice question where we said, you don't have to have a total decline across your organization. You need to have a nominal portion of your business based on 2019 business, and it needed to be 10% of your business. That had to have a decline of at least 10%. So I think about that with our healthcare providers, our nursing homes. I use that analogy often of the restaurants because they qualify. They obviously were impacted due to COVID. In some cases, strangely enough, their drive-through business more than offset. In some cases, they're in-person dining. So we talked about provider relief funds. Let's just dive into that a little bit more because we run into the question a lot with PRF. Generally recorded as revenue when earned and recognized. Some organizations did not record PRF as revenue in 2020, even though it maybe was earned. I'm thinking about some June 30 year ends where the regulations just were still kind of vague, and I've heard they were clarified in July. So then, July 1, brand new year end, you could record it. Issue is you probably didn't record as revenue until the following year end of 6/30/21. So, we'll look at that for ERC and go, okay, let's look and break it down into the quarters and see when you probably should have recorded that in the quarters that you earn the revenue. So when you look at PRF again, remember you qualify based on COVID-19 expenses or you had lost revenues. So when we can look at the HRSA applications and see when did you have the lost revenue and when should we record those as revenue. When you think of that June 30, we probably should record a lot of that as revenue in that first quarter, July 1 through, the first quarter starting July 1. So Q1 of 2021, that will have an impact on your gross receipts test. As PRF funds are included in gross receipts for ERC. So like I said, there's very little guidance on which quarter to put it in. So we just need to make sure we earn the revenue and see which quarters those should be in. There, and that brings us to our next polling question. All right, wow, look at this. We must have explained this well. So they cannot, right. So healthcare organizations cannot qualify for the ERC because they receive PPP and provider relief funds. That is false. You can qualify for ERC, no matter those things. You just need to have what we talked about, nominal portion, government orders, those types of things, or absolute decline in gross receipts. So you can have PPP and PRF and qualify for ERC. Let's go to Brad. Do you want to take this as our last slide?
You bet. I'll take her. All
Perfect.
right. So again, as we've been working with our clients, this is absolutely something we've noted for several. That is a great opportunity for providers to receive some very substantial cash flow, certainly helping you as an organization plan for the future in our ever-changing healthcare industry. The qualifying criteria, remember, you can either go and look at it as a decline in gross receipts, or you need to have that government order which affected to more than a nominal impact on at least nominal portion of your business. Nominal is usually defined as 10%. That's just kind of the general IRS rules out there. Up to $10,000 of qualifying wages are eligible to receive the credit. In 2020, it was 50% on the annual wages up to $5,000 per employee. So if you think about that, 2020, you can only get $5,000 per employee. But 2021, you can get $7,000 per employee for 3 quarters. So $21,000 total credit. You need to have under 100. Oh, okay. Then we just got a 100 employee provider organization example. So when we went and looked at it, if you've got 100 employees in 2020, you could receive $500,000. In 2021, and you qualify for all 3 credit quarters, it'd be $2.1 million. These are absolutely substantial funds, and certainly something as an organization, like we said, future cash flow planning. How do you our environment's changed in healthcare. There's absolutely no doubt about that. Organizations are going to have to change their delivery models, adjusting to new services, maybe in your communities that you're going to be able to provide on more of a home and community-based services, changing your workflows within the organization. I think a lot of organizations have said there's things that they look at now and say, boy, this is better for us to do certain things here because of a little bit of change in occupancy, but also changing in staff and staff requirements. They just found that they're going to have to do some changes. These are opportunities to access some of that cash flow to help you get there. So again, very substantial credit. If you have any questions here, please reach out to Sean or I. We'd be happy to visit with you further on this and just see what your thoughts are on your organization and how you might qualify. Because we spent, between the two of us, we spend a lot of time talking to our clients, and some when they call, I just don't see how this is going to work. After we truly sit down with them and we explain this in a little bit more detail to their organization, wow, we qualify. This is awesome. And it is a great opportunity right now that's available. And if you would like to take advantage of that, please let us know. We'll help you walk through it, help you figure out what you need to do, and again, help you get some access to some great funds. With that, I want to thank every one of you for joining us today. We greatly appreciate you taking the opportunity to listen. We hope we've provided you a little bit more clarity on how this employee retention credit can help you and your organization. Sean, any last comments from yourself?
No, Brad, I think you nailed it on the head. Like you said, we're spending a lot of time between the two of us working with the senior living industry, finding out that a lot of places that maybe we didn't think qualified before do qualify for this employee retention credit. It's a great opportunity for some greatly needed cash flow in this industry. We've worked a lot with a lot of different providers across the country, frankly, on this initiative, and look forward to questions or future thoughts to come from anyone on any questions on how to take advantage of this opportunity. So